Hey, this is Ken Pitts, and today I'm going to give you a behind the scenes look at how financial planners are using reverse mortgages today. Not as a last resort, but as part of a smart long term strategy. This is part of the Life After 55 series, and this topic is something I get asked about all the time. So if you find today's topic helpful, be sure to like and subscribe to my channel. In my book, Kinetic Wealth, I walk through how reverse mortgages have evolved and why more financial planners are starting to include them in retirement planning that they're doing today. So today we're going to talk about three things: real world case studies of planners using reverse mortgages as a volatility buffer, when this tool is recommended and when it isn't, and how does it fit into the broader strategy alongside Social Security income and investment income. So let's talk about some case studies where planners have been using the reverse mortgage as a volatility buffer. Boy, the beginning part of this year is a perfect example. If you have in place a reverse mortgage that's set up as the home equity line of credit version, for example, you have availability to tap those funds at will. You don't have to take them monthly. You can use them as you need them. In the case where you might have a lot of volatility in the marketplace and you'd rather not be drawing your funds off of your retirement income when the market has dropped significantly or has been having violent ups and downs, you can turn to that line of credit and draw funds from there until the market finds its bottom or finds its feet and starts to move forward again in a way where you're more comfortable that your assets are protected. This is a great hedge against volatility. And volatility can happen for many different reasons. You know, you could see it happen from political reasons. You could see it happen from different world events. You could just see the natural progression of recessions that come and go. That's the natural flow of our economy and how our markets work. Having this availability to tap into the equity of your home as a way to draw cash flow while you sit on your assets during a downturn gives you that flexibility to move back and forth. It's a sequence of risk. When the market's risk is high and there's a lot of volatility, you turn to your hard asset, your home, that you've now got liquid access to through the home equity. When the markets regain their footing and they get some momentum and they go positive, then you can start to draw your money off of your IRA or Roth IRAs. You can draw the money off of them. Then you will have really retained your principal and possibly even got some growth out of it while you relied on the home equity line of credit. Leaving the home equity line of credit alone during periods where the market is running hot and you're making money in the stock market or your bond investments or both is a great tool, because that line of credit is going to grow. The unused portion of that line of credit is going to grow, so you can tap into it later if there's some market volatility. So it can really work as a great hedge when markets are a little unstable. What are the situations where I would not recommend this? This is our second point. There are times when a reverse mortgage, maybe not necessary, but more often than not, when I don't recommend a reverse mortgage is if it's going to be a last resort. If it's a last resort, it's because you can't afford to be in the property that you're in. Maybe your maintenance costs are too high. Real estate taxes have gone through the roof. If you can't really afford to live in that property or live in the area where you are, you really need to consider stepping into a different environment, maybe selling the house and renting, or selling the house and moving to a lower cost area. A reverse mortgage is just going to be putting a Band-Aid on the problem. What you really do need to do is find a solution. Our third point today is, how does a reverse mortgage fit into a broader strategy alongside Social Security and investments? Well, it really becomes an additional cash source. It can either be a cash flowing source where you're pulling money off of a home equity line of credit, or you take a fixed home reverse mortgage and you're drawing a tenured payment. You can even do a tenured payment off of a line of credit. It's supplementing your monthly income. It's a cash flow drawing out of your residence. So that's one way you can supplement Social Security and your investment portfolio. But another way to think about it too is when we have debts that are out there, maybe credit card debts or an existing mortgage that hasn't been paid off. Those are drains. They're draining your asset bucket. You have money flowing out. You could utilize that reverse mortgage to plug those holes, pay some of that debt off. That puts less of a strain on your monthly cash flow, and it makes your Social Security and investment income that much more important. And it's going to give you a lot better, more secure feeling when you know you don't have debts that you have to pay. Because always remember, the reverse mortgage, although it's a debt secured against your house, does not require a monthly payment. And as such, doesn't add to your cash flow burden. It actually enhances your cash flow. So one of the biggest takeaways from Kinetic Wealth, my book Kinetic Wealth, is that financial security, it isn't just about what you have, it's about how you use it. The reverse mortgage is a tool, and it's one of the most unutilized strategies that I've seen. In the next video, we're going to wrap up this series with one of the most common questions I hear. Should I take Social Security early or wait until age 70? Thanks for watching.